Welcome to our second quarter newsletter in 2023. Let's get right to it. The largest bank run in history just recently occurred. Customers withdrew $42 billion from Silicon Valley Bank in a day. To put that in perspective, the run on Washington Mutual in 2008 took place over 10 days to the tune of $16 billion. But $42 billion in one day? No financial institution can survive that kind of outflow. Silicon Valley Bank, or SVB, was a specialty regional bank. Their customer base was like a well-knit country club of tech-savvy venture capitalists. Almost all the deposits at SVB were business accounts with balances well over the $250,000 FDIC insurance limit. And in the past few years, as venture capital was doing very well, the bank became flush with cash. But with cash coming in so quickly and interest rates still at zero, the bank was struggling to find ways to make money off of all those deposits. And this is where it started. The CEO, Greg Becker, became so focused on ambition and the future of venture capital that he forgot that banking, when it's at its best, is supposed to be a little boring. The temptation in banking is to use all those large piles of money to make more money. The job in banking is providing a safe, prudent environment for customers to keep and access hard-earned cash. There are a plethora of risky investments to choose from. Our bank shouldn't be one of them. But SVB put upwards of 75% of their investments in long-term government bonds to try and get a better interest and revenue rate. Now, you might not think government bonds are risky because they're not if you hold them to maturity. But when interest rates rise quickly, all long-term bond prices drop sharply, no matter the type. In contrast, the average bank the size of SVB was much more diversified and had only 6% of their investments in long-term bonds. On top of that, not only did SVB not diversify properly, they didn't hedge that big bet either. What else happens when interest rates start to rise? This risky startup world of venture capital slows down. Very quickly, SVB venture capital bank customers were not only depositing less cash, they were actually starting to make withdrawals. So much so that SVB had to go and sell those long-term bonds at a huge loss to give customers their cash. Mr. Becker was working on a solution to raise fresh capital after the investment loss, but his letter to depositors about his action that was meant to comfort them only frightened them. Their reaction was a quick punishment. From there, the crisis of confidence spark lit a fire in regional banks. These kind of banks tend to have a more concentrated customer base in certain industries. It makes sense because their specialty helps them thrive in the first place, but it also leaves them vulnerable to problems that can occur with that one industry. And as with any well-knit group of people, these depositors can act suddenly to move funds in large quantities. Fear is a powerful motivator, and it's highly contagious. So beyond the regional banks, any bank with problems or even perceived problems is scrutinized. But when Charles Schwab and Credit Suisse were next to make troubling headlines, that was a head-scratcher for some folks. Until this happened, many people didn't realize that Charles Schwab has quietly become one of the largest banks in America by deposit. More than half of Schwab's total revenues now come from Schwab Bank's net interest income, which is the spread between what they pay on deposits and what they get on investing those deposits. So, whether deserved or not, fear of banks is now going to impact Schwab. Regarding Swiss banks, Credit Suisse was already in trouble, and fear made it much worse. So much so that even after the Swiss government injected the bank with over $50 billion, a weekend shotgun wedding to UBS was required by the Swiss government to save the country's banking system. A system that really was their national identity, cultivated over centuries to safeguard the world's wealth. And as the Wall Street Journal pointed out, now that there's just one huge Swiss bank, UBS, what if something goes wrong with them? It's still too early to know if the Swiss have fully contained the damage, but in an industry where reputation is everything, Switzerland is no longer the panacea it once was for the world's wealthy. Things change, sometimes right under our noses. Fear can expose that change at a shockingly quick pace. Therefore, I believe headline risk will be high this quarter, along with the possibility of sudden market pullbacks. I don't think it will last long, however. Statistics will most likely show soon that we are already in or about to be in a mild recession. Typically, when that's official, companies begin to downshift revenue expectations, we hit a bear market low, and eventually start a new bull market. And yes, this is my base case that all of that happens this year. The downside risk, as always, is further contagion and the unexpected. So we take the lesson from the Silicon Valley Bank CEO, and we don't put 75% of our investments in any one thing. Diversify, buy quality, and only invest in risky assets in smaller amounts and at the edges of your strategy, and only if you have the stomach for it. If you're a long-term growth investor, stocks are still the best place to be. If you're retired and taking income from your portfolios, always have enough of your investments set aside in safe things that can get you through any rough period without selling. I explain how in more detail in my video, The Wealth Replacement Method. You can find it on my website. Click on Investor Education at the top, Retirement Planning on the left, and you'll see the link. I've heard from so many of you that you're enjoying my videos, and it means the world to me. It wasn't easy to put myself out there on video to be potentially criticized, but I decided to be a rhino, charge ahead, and just go for it. I'm so glad I did because the support has been incredible, and what's happening now for my career and my business is what I only thought might be in a dream. But it's a reality, and as you can see, I'm collecting many more rhinos every day. I also had to laugh. One of my clients who saw my video on what it was like for me during the dot-com crash gave me these from his office. This is an Enron golf ball, and this one is from WorldCom. So now I just need one from SVB, and I'll have a shelf of all the reminders of the importance of risk management. Thank you to all of my clients. You're still with me, and I take your confidence and financial security to heart. I look forward to many more years with you. And lastly, thank you to my team at LaSalle Street. This transition could not have been done without you. Your compliance and operations experience and long-term relationship with Fidelity have made everything possible. You cater to $13 billion in assets and yet somehow have the culture and assistance of a family business. I'm so glad I chose you. Let's charge bravely ahead together this quarter. As always, email or call me anytime, and I'll see you right back here in June for a Q3 newsletter. See you there.